Hello, hello, hello. Very excited for our deal launch. And this is an exciting deal. It's actually one that I invested in already, and I wanted to share with you. So what we're going to do, and the whole idea with the deal launch, we want to keep it short, but we equally want to take you through the highlights and what's important. So let's go straight here. You should be able to see my screen. If you can just confirm whether you can see my screen or not. And what we're basically going to be doing is running through an opportunity, which is in Phoenix. And it's a $10 million deal. It's got an 18-year triple net lease, and it's in the industrial sector. So it's a really, really exciting deal. Now, if you want to go read all about it and all the kind of the material, you can literally go in here and you can go see it all. So it's on the platform, and you can literally go and see all the information. So you can go into it, and you can see there's a video of Phoenix. I've done a short video in terms of what the deal is all about. You can go look at all the pictures. You can look at the deal reports. You can look at the risk. You can the deal calculator. You can download the documentation. Everything's already here. So investment summary, market summary, distribution overview, sponsor due diligence, everything. What I wanted to do, and what I'm a big believer in, is to condense things. So to make it easy for people to be able to make decisions. All of you, your time is really important to you. And so timing is everything. And just before I do, I'm not giving you financial advice. What I'm doing is, having done this for 28 years myself, is I go through all the documentation and I literally go, these are the key points. This is what I would look at, and this is why I would look at it. So the first question is, why are we here? Now, this is a deal that closed a year ago. And sometimes, something like this represents a real opportunity. So we bought the deal a year ago. It was exclusive only for our mastermind members. And the reason being, the deal moved very, very quickly. And we could only work with our mastermind members. We couldn't actually get it onto the Migrate platform at the time. When they closed the deal, Judd's the principal of DWG. He had someone that agreed to put in $500,000. And with regards to that $500,000, the promises, I don't know if it was a man or woman, it's irrelevant, basically said it's coming in a month's time. And he said, no problem. And so he did the closing, and he put the money into the deal on their behalf. And what went to a couple of weeks, went to a couple of months, got to Christmas, and don't worry, it's coming soon. Anyway, recently we spoke to them, and they were like, look, we've got this opportunity. The deal's working. We already own the deal. It's paying every month. It's a performing asset. Do you want to take out this person's position who's never come up with the money, because Judd wants to release his capital, but he'll do it at the exact same deal as a year ago, even though the market's got a lot stronger. And we were like, yep, that makes absolute sense. We're already in the deal. So this is, the original email that was sent in April 2023. We were really excited. We got involved in the deal. Like I said to you, it closed. And then a year later, we were given this opportunity. Now, a lot of what I'm going to go through is that, we believe in the laws of nature and actually working together. A bird flying in a flock can fly 70% further than a bird flying on its own. And this is a really important principle, because in simple terms, you can try go to America, you can try learn everything about every state, every asset class, every city. You can try figure out how to get financing and all of that type of, or you can literally partner with people that are doing it on the ground. So the key points of DWG, which is our partner on the ground, is that they're institutional excellence for private investors. So they specifically focus on high net worth and sophisticated investors. They've got over 18 years experience in the capital market. So this is really, really important. A huge amount of experience. They've done over $1 billion in commercial real estate deals in multiple different markets and geographies around America. They've got over $50 million in under management, and fast expanding. That's expected to be $300 million within 12 to 18 months, because they're really taking advantage. Often chaos equals opportunity. If you look at my wealth code, it's one of the 12 things. Chaos equals opportunity. Because interest rates have gone up so much in America at the moment, there's a real opportunity. There's a lot of distressed sellers, and Judd and the team are taking full advantage of that. So that's what they, using their seasoned professionals, they're creating above market returns. They look to partner with owners. So their business model is an interesting one. They go into owner-led businesses that already own their commercial real estate, and the business owner wants to recapitalize the business because they believe they can put the money into the business and they can grow the business a lot quicker using the capital. So what they do is they sell the building, but with our partner Judd, we buy the building. And then what's interesting is that they lease the building back for us on a long-term lease. So generally 16, 17, 18, 20 years in terms of the process. So that's the model. So you've got a business that's already established, been around for decades. You buy the asset off them, and they become your long-term tenant. So it's a well-known model in America. It's a well-known model around the world. It's an effective model. It's a predictive model, and it's good for income. And what ultimately it allows us as investors is to get involved, almost like a private investment club, where we get to participate and invest alongside Judd directly into the deal. Now, the capital markets are very volatile, like I've already mentioned. Interest rates went up starkly. And so you've got to be careful. You've got to have a strong team. And I know one of the things that people say is, I can't get leverage, or, if I go to America, I won't exactly know how to get leverage in terms of that whole process. And so you've got to have a strong team on the ground, and in this particular deal, as an example, the interest rates are fixed. And Judd, I was just talking about you and your team, and giving people some insights into who you are and what you guys do in terms of the overall process. I'll come to Judd now, but I just wanted to share some of the key points that I think are really relevant out of the learnings I've had the privilege of working with Judd for a couple of years now. It's been at least 3 years, I would say. And just some of the key things that I've taken away from his presentations is that one of the things that he shares is that if you invest through recessions, by the time you get to 65, you're actually going to be 30% ahead of people that try and time the market. And again, Judd, I'm going to come to that because I want to talk to that. This is your third recession in terms of, where you've been through. And a saying that I love, don't wait to buy real estate and wait. And I think that's such an interesting point, because you need to be looking at the fundamentals and what is actually going on in terms of it. And so what I wanted to ask you, Judd, and firstly, thanks so much for joining. I really appreciate it. I never know where you are in America, because last time, it was a week ago, we were talking to you and you were on the ground buying an industrial building. Literally, our mastermind members had the privilege of learning from you on the ground. But, where are you at the moment? You're muted, mate. You're muted.
Yeah, I'm back. Hello, everyone. Good to be back. And thanks, as always, for another collaboration with Global Wealth. I have to tell you, the more that I might just quit and invest. I think I'm just going to invest in the world through Global Wealth. I'm just kidding. But I'm really impressed, continuing the last panel, the people we met, and just congratulations. And it's so great that you're democratizing the sophistication of this. And I'm not selling you guys. I genuinely believe that. I've seen, as Scott was saying, I've been around. Hello, Alex. I've been around for quite some time, and as a result, I'm third generation. My dad used to say hang out, and all we did was drive land. My granddad was the biggest developer in southern Florida, so I'm a real estate fan. My uncle was created middle markets for Merrill Lynch. So I've been around the industry a very long time, and I've seen a lot of recessions. And I remember actually with taxation, to give you one quick note, my uncle at Merrill Lynch, get this a little clear here. My uncle at Merrill Lynch, he said, don't worry, well, we can just always out earn those bastards. And he was talking about tax cycles and situations in America. And what I love about that statement is like, there is this, America always bets on itself to the very last moment. It restructures. It's got extremely, attractive legal system, actually. There is better free market systems or parallel free market systems, but our legal system and our inherent value in a number of cases make us a pretty powerful investment country. So every time I've looked back over a period of 25 years before that, so 25 years total, I have very few. I wish I didn't buy that, because you can look at the aggregate values over time, and you can look at it as it relates to inflation, and look at it to our GDP, and you can still see. And if you even understand our American debt as it relates to GDP and its ratios, so what we spend and the amount of capital that's moving to markets, that's changed over time. American real estate and our institutions continue to be really, really vibrant. So Phoenix is a great example, because desert economies like Phoenix, Vegas, the Inland Empire, they can tend to have certain levels of volatility as it relates to desert economies. Why? Because the economy is not in a macro, but it's in a micro, like Phoenix. But eventually the expansionism of the metropolis itself becomes so big, it has a momentum. So there was a lot of deserty stuff on the edge of Phoenix. Not now. Phoenix is now a major, consistent, solid player like Los Angeles. It's right in the path of post-logistic distribution America, post-COVID. And the growth and the job growth and the attractiveness of their tax rate has all been really, really powerful. So looking back on all those all those prior cycles very, very, very few times do we not want to buy and continue to buy. And it really is a lesson that cost us all millions and millions of dollars. You don't want to be prudent and stop investing. You want to invest more prudently, but never stop investing.
Yeah, look, I mean, what's quite interesting, and I spoke to it as you were joining, and again, we've had the privilege of doing a couple of sessions with you with our mastermind members, and you've consistently said that yes, the capital markets are volatile. Yes, there's chaos on the ground, but equally that represents opportunity. So talk to me a little bit about kind of DWG's mindset to take advantage of this opportunity at the moment, to use your experience and again, to unlock opportunity for investors.
Yeah, this deal's kind of an anomaly. So we just closed our 10th deal, Buckeye Shape Forum. We were on your conference on the floor, which puts us at like 60 million AUM, about 600,000 square feet in under 2 years of American sale leasebacks, and we're below replacement cost industrial. But you want to buy in a Class A area whenever you can. So there's two buffers, and the first buffer is the credit tenancy of the actual tenant that creates a bond when you do a sale leaseback. A sale leaseback meaning the tenant owns the building, the tenant owns the business. They hold the business and they sell the building to us. Sale leaseback. So when you do that structure, the credit, the second you box the credit, you create a bond, right? So I've got a 20-year lease. Well, that's like a 20-year bond. So the value goes up through the structured financing. So this isn't like flipping apartment units. You're creating a bond based on expanding a business for strength, and then that business starts to get value itself. So you have the sale leaseback, and if you have really strong credit, you can go a little more tertiary. Why do warehouses want to be outside of big cities? Because the ingress and egress is easy. They're looking for arteries. It's all about time to their people. But if you can get something that is urban infill like Airbag, which is right smack in the middle of Mesa, in the middle of Phoenix, by Chandler, by Gilbert, some of the hottest three markets, then you've also got inherent real estate in a market. So the second tenant becomes the urban infill marketplace guaranteeing the lease. So we have three of those. We have one in Fayetteville, one in Austin, and our other locations are good, but there are hot markets, like Austin's hot, but that one's hot, and this one. And actually Columbus just became the biggest growth market in the United States. So we're investing in tenancy and buildings below replacement costs. But Phoenix is a unique find. Down the street, brand new ASU apartment units by an industrial project. So it really is a core infill real estate project. And if there was ever issue with the tenancy, it was formerly a Coors cold storage building in the 80s. So it's built at like twice of the cost of an industrial building. So it has a really high replacement profile as well. We got it at an 8.12 cap, and the banker called up and said, hey, this is a 5.85 market because we own Rembrandt Stone and Tile in the same market. How'd you get this? And our press went out. A business broker was working on that deal, called us from Canada. This gentleman there was a takeover, and he had never really done a sale leaseback. So we quoted the high level numbers at the right moment, and we were able to get a high cap rate deal in a low cap rate market as well. So a lot of neat
Joe,
things
quickly, I just want to put that into English, what you just said there, okay? Like, so anyone that knows anything about property knows that generally you want to try and buy property at a discount, in simple terms. Okay, so you've said two things that are really important there. Firstly, you're buying it at a discount. So if you're buying at an 8% cap in a 5 market or whatever you just said, it's rough, it's about a 25% discount, like straight away. That's and then the other thing you said was replacement costs. So what that means is physically, if I go build this building, these bricks cost money. And what on this particular property, we're buying it at 39% below what it would actually cost to rebuild the building. Now, both of those things are really important for an investor if you're wanting to understand value and getting it at a discount, in simple terms. And I know there was a report when we invested a year ago in this opportunity. I've already explained the timing of the deal, Judd, was that Collier's actually estimated there was over $1 million worth of equity literally sitting on the day of transaction. So the day we bought the property, there was roughly $1 million. And I'm just trying to put into English what you've just said, because it's really important for investors to understand that.
Yeah, absolutely. Hey, can I screen share one slide for 1 minute, or do you?
Yeah, please do. Yeah.
Okay, great. I don't have the one that I have your branded one here, but just look at this for one second. This is it just to cover.
Oh, you're good.
And I'll just be quick on this and I'll pop out. I mean, this is what we're talking about, urban infill. You know, you'd usually see something way out with a bunch of trees around it, right? I mean, you've got the ASU campus locations up here. This street, Broadway, has become exceptionally like hip and hot. You've got like all this different industrial around it. I mean, this is a very, very dense core location in the center of Phoenix. So there's an inherent real estate value, and that's what we're referring to. In a way, we got lucky. Like a lot of people are like, how the heck did you get that? And we're like, you know, just it was the right time. We knew to like one of our companies, Mag, right, that you know that we build and wrote under. They're like, you know, we'll buy anything in Phoenix that makes sense, and the cap rate was attractive. There's a little risk in any deal when you put a tenancy in there. You know, this business has been around since the 80s. They do all the infrastructure called airbags and air suspension for lowriders, custom cars, etc. So it has a retail and industrial element to it. But the tenant's been around for a long time. They're working on 3Xing it. We've made several companies 3X, and we think that the tenant's also got the potential of going into like what we call a PE roll-up. So that means like an Arco or somebody else could buy them over time. You know, it's a really neat space. And also on a community level, there's a huge wall on the left-hand side, and they're going to bring in a lot of different spray painters, which relate to that automotive element from Phoenix, from Atlanta, from Georgia, from Texas. They're going to put like murals from all the United States. They're working on a big PR event. They're working with celebrities. It's a neat business and product.
Let's just go through some. So what I try and do, and you know, Judd, you know how I do this. I go read all the reports. I watch all your webinars. And I kind of try and come to 30,000 feet and help people. So just for the international investors, and again, without the assumption people even know where Phoenix is that this is a pretty standard, you know, it's not, as Alex doesn't like my map. He says it's not sexy enough. But anyway, I think it's pretty simple. It just shows people where Phoenix sits, you know, right next to Southern California. And, you know, this is what Judd was saying. Logistically, this is really, really important in terms of, you know, just where it's positioned in America. And then if you look at just some of the important points of Phoenix, you know, it's one of the top 3 markets to look at in 2023. The region has strong proximity to South California. You've got population growth, business friendly, so it's very tax friendly. Phoenix MSA is one of the top 5 industrial markets with exceptionally low vacancies. So vacancies are below 4% and double-digit rent growth. Funny enough, it was 14% last year. You've got urban fill, you know, in Phoenix. There's a strong corporate environment. So it's one of 3 states which has experienced full recovery since the COVID. It's the 5th largest MSA in the country and the #1 city in America in terms of population growth, and a lot of large tech. And, you know, I just think it's really important. You've already started talking to Phoenix, but one of the things, you guys are not stuck in one city. It's not like you only live in Phoenix and you only do deals in Phoenix. You have the privilege of looking around America and looking for the cities with high growth. And, you know, if I was to say to you in summation, and I know you've already kind of gone to Phoenix, but why is Phoenix one of the markets that you're focusing on and are interested in? And quite frankly, I know everyone knows that you already own this asset. So you're a large owner of an asset in Phoenix, you know?
Yeah, I mean, the rent growth was, the easy answer is rent growth was 15.8. I mean, that's a massive distribution logistics change. If you understand what, you know, they've always said industrial, the not so sexy asset class, right? You don't drive out in the middle of the country past the city borders and go, wow, that's an amazing industrial building. You might if you love if you love boxes, but what you really want to look at is the market. And as industrial has come up, it used to be like the 10 cap, 20% vacancy asset class. Well, last year they did an analysis, and because of COVID, because of retail vulnerability, because of office decimation with the changing the workforce, which it will recover in time prudently, because multifamily is in its 9th quarter and you know, 8th, 9th quarter, very mature asset class. You have to choose probably, make sure you're making the right decision. We just did one that we're really happy about. As industrial itself is at 15.8, rent growth is exceptional, and the vacancy rate is 3.8. So there's no magic to that. This market is exceptionally hot, so it's got exceptional demand. So let's say you had to replace your tenant in a market like this. you should have no more than 3 to 6 months exposure, and you should have multiple people at the table. So you have that second level of degree. So love Phoenix, love the markets. It's also sophisticated. It's like coming along, like the whole state, that area is it's really attracting a lot of other business as well.
So if people notice what I'm doing here, I always start with a partner. Like people think I just go and invest, we just go invest in a property. It's never that. You always start with a partner. So we've started with Judd, we started with DWG. Then we go to the city. So, why is the city? Judd's already covered the asset class. Now the next question is, well, what about the deal? Why would I consider this as an investment in terms of deal? And these were just some of the highlights that I took out of this. So I've already mentioned the purchase price being 39% below replacement cost. 13% rent growth. Sorry, I said 14. I was 1% off. 13%. Sub 4% vacancies. It's an 8% cap and a 5.8, which Judd's already mentioned. There's high barrier to entry because it's this urban infill, so it's not that easy. So, Judd, talk a little bit to that, because I know you mentioned it to our mastermind members when we invested a year ago. There's quite a lot of industrial in Phoenix outside on the peripheries, and there potentially could even be supply issues, oversupply. But in the urban infill, there's no space, so you don't have that problem.
Yeah, I've got the exact stat. With more than 33 million square underdeveloped, Phoenix remains the fastest growing industrial market in the nation, and it's business friendly and lower costs. So you've also got like states like California. A lot of the blue states are having a lot of issues with legislation. There's been a lot of movement of labor around. Arizona is really friendly. It's definitely purple, and not to get political, but politics do affect when you're making decisions. You always look at that. And also the labor force has had exceptional growth as well. So they're pulling away from the Texas boom. So those are a couple of the variables that I think are important there. Those are real elements of things happening. So
if we look here and we just keep going through this deal, it originally had an 18-year lease, so it would be 17 years now. It's, as Judd's already mentioned, a 25-year-old company. They originally had a 3% escalation and then a 2% escalation. So you sort of covered at an inflation level. They at the time of purchase, they were reinvesting $250,000 back in the property. They're doing $6 million in revenue and aiming to go to $12 million. So this is important. Like, you should always understand why they would do this. And the logic is they're going to invest their money in their business because they believe they can get a better return on investment in their business than they can in the real estate. So it's win-win. Us investors get to partner with DWG. DWG facilitates investing and owning the building, and we have a strong tenant that runs their business, in terms of the model.
Yeah. There was one note on that. There was a supply chain constriction from an exiting partner that got purchased out. That's why they did not intend on selling the building. So it enabled that moment in time, allowed us to get to the asset. I mean, I can't find anything around Phoenix even close to this.
Yeah. We bought it 10.4 all in. And as I already mentioned, Colliers believed there was over $1 million in value. It's got a 7% cash on cash, and the debt is fixed for 7 years at 5.9 at a 70% loan to value. Now, again, this is critically important. Like, the capital markets are all over the place, and one of your greatest risks if interest rates are going up. I'd love you just to talk to this, Judd, because one of the objections I get all the time is, but if I go buy a house, I can get a mortgage and I can leverage. And I'm like, no, you don't understand. Like, if you're partnering alongside DWG, you've got a mortgage, you're fixed for 7 years, and you've got a 70% loan to value. And I mean, you're actually personally at DWG level taking personal recourse, but the investors are not. So you're actually getting access to finance at far better rates than you can as an international investor anyway. But yeah, just talk to us about the financing component, because I know it's one of your specialities, which it needs to be with where the markets are at the moment.
Yeah, absolutely. I realized I'm in my low chair.
And that's all good.
But I'm actually a normal height person. Yeah, the background is I went from Keller Williams Commercial when Starbucks bought that institution to Guardian at Sperry Van Ness, came in and bought that institution. And then I was involved in the Newmark roll-up where Cantor Fitzgerald, one of the biggest 9/11 affected companies, bought us there. It was a great story. And we bought a number of other entities. And during that time, when I came in, which relates to this, I'd always done joint ventures in the retail space. And when I went into Newmark, I got into the debt equity restructuring space during the last crash period. And as a result, what you have to do is, if there's ever an issue, you have to understand, like, what is capital markets? It's the intersection exactly where cap rates are, where debt is, where equity is, where investors' return are. So it's structured finance, and your job is to know where everything is transacting. Adam Smith's invisible hand, the theory of free market capitalism, is that if you get out to a market and press the clarity of the people that will supply, demand will set its own level organically. And that's placing debt. Like, you have to get out to the banks, you have to get out to the national banks, you have to get out to the CMBS guys, which is collateral mortgage-backed securities. You have to look at swaps, which is the swapping rate. Then you have to look at credit unions and local banks. And so then you create a mini market of demand for the debt on all the deals you guys work on, right? And so what we have a responsibility. We have 265,000 people in our debt database internally, and then we use a couple other sources. I mean, just our debt databases and our structured database, about $100,000 just for the infrastructure to buy. That's not including salaries. That's just online capabilities to seek the debt market. So then you create a mini market. I've got a lot of experience in that. And then we bid against them without breaking and alienating the bankers. Bankers are pretty good to know that they're gonna lose or win. So last point, your investors might be interested in this. So everything is based on a spread and an index. So they'll say, hey, 5-year T and 275, 200, 215, or we might use LIBOR and this spread. So you're playing with different indexes and different numbers. So we have to find the very best for you. We won't sign anything but the very best find in the country available at that moment. And we'll do it by creating a mini market. So that 5.9 is best to market. We just did a deal at 7.15. That's where we are today. Last point, Scott, I know I'm long-winded, but it's very important to know where we're going. And the Fed is saying in projections in the last 21 crashes or 21 cycles of raising, 10 cycles of raising, in 21 months, we go down 190 basis points. Well, we did pretty good because we're at 7.15. We're at 5.9 right now. It's already at 7.15. So in a couple of years, we hope to be refinancing at around a five handle. And if you look at the Fed's estimation, they think the 5-year T is going to go down to 3%, our index here in America. So we've got, we're in a good position. And that's what we do on every DWG deal, is we also are former and current debt brokers. So we bring that element to our clients. And then I sign on all the guarantees.
It's just so interesting listening to you. And I mean, I know what I've been doing. I've been doing this 28 years. And I just sit there listening to you, and I have to pay serious attention to understand everything you're saying. And I think if there's one overriding message that I'm trying to teach investors, is that, you can try and do it all yourself. You can try go figure out how to get all that finance. And by the way, it's impossible as an international person. I don't even care if you've got $100 million. Or you can partner with someone that actually knows what they're doing. And as Judd just explained. I want to share a couple more things that are relevant here. And Judd, I do on purpose keep this short so that people can kind of get the context. They can go read all the details on the platform. So some of the things you said, you mentioned the cold storage, which gives vacancy defensibility. There's an 18-year lease in place. Mike Wilson, the owner, has personally guaranteed the lease. There's strong market comparables, so you can literally go on the documentation and you can read about the sale comparables and the lease comparables. So again, if you wanting to do your due diligence, it's important to be able to see, okay, what are we buying for? What's the market comparables? And see that not only are we buying at well, we already own it, but we bought it at a very good value. Plus, the leases make sense in terms of that process. Judd spoke to the construction pipeline in MISA being minimal because it's infill. So it's the city center. There's very little space in terms of what is actually happening there. And then, one of the things that I'd love you to talk to is risk. And when you look at it, there's the kind of this single tenant, the strategy of the single tenant triple net leaseback. And tell me just, from your strategy perspective, Judd, there's a couple of things that you guys specialize in. Firstly, this triple net leaseback. Secondly, the middle market investing. Thirdly, how you manage the capital, rise in interest rates. Talk to me a little bit about risk, because as well as I do as an investor, it all sounds good, but how do we manage the risk,
Well, I've worked for other companies for years. I mean, the way that we are looking down the road at a fund, but what fund is about velocity and diversification. But we have credit risk teams, $20,000 for them to look. It's another $15,000 for the cost tag analysis that I pay out of pocket up front. Then I have an amazing accountant CFA that we do another run with, and that guy is out of the Ukraine. Really, really genius gentleman that I've built the company with. Then we go to our lawyers and we look at the risk level, so all the legal documents, right? And then we go to our CPA, and then we run all of our financial analysis behind the credit risk to make sure that the tenancy doesn't have holes. Then we do background checks. Then we vet it across the market as professionals. But if there was ever an issue, what's my background? I mean, I just leased. I have a client who had a $40 million deal, and he lost half of the deal to somebody else, and I leased it to a $3 billion company in a few months because I know how to run leasing. I've done that as well. I've done billions of dollars and everything. I'm not not bragging. I just have to, to survive and thrive in the market. I've always had an interest in all of America and all of the asset classes, which made me a capital markets institutional guy that would hire teams. So I do understand like every facet of almost every piece of type of real estate in the United States. So if we have an issue, then you look at like, okay, absorption timing, tenant replacement, value compression, exposure. So, the way we've structured our security deposit, I think we're buffered from that. The market's really hot. That's it. Just standard, prudent structuring, and choosing good companies and good real estate.
So let's go to the numbers. And again, people can go and read all about this, but you're looking at a 7% cash on cash increasing over time, about a 17% IRR in terms of the target. It's a 3 to 5 year hold, which means if you put in $100,000, you're looking to double it, the ROI, roughly in 5 years. So it's a 2x on equity multiple. So roughly about 20% a year. And we've already owned this for a year, and it's paying monthly. So I know that because I see the distributions come into my Wells Fargo account, and literally every month without fail, I can't remember exactly, it tends to be around the 5th, 6th, 7th of the month, but the rent comes in, and within almost a week, it's paid out. And talk to us just a little bit about that, Judd, because that's unique. I've been doing this for a long time, and people generally pay quarterly or sometimes even every 6 months. What I love about working with you guys is you literally get paid monthly, which is phenomenal,
Yeah, it's interesting. I mean, if you look at our asset management fee in there, whatever it is, a couple points. I mean, there's no profit on these deals. I'm basically a partner in there. We have minimal cash flow, just like beside you. I structured this company, these deals, to kind of like pass on what I think is institutional excellence. I used to make the institutions rich. Now I get to make friends and family rich. And this may sound pedantic, but the whole point of this freedom creating through cash flow, right, is so people have more time with God, family, and nature. God, family, and nature. So we're doing our job, and it's as easy as a click of the house click of the mouse from the office or the house with these guys with Global Wealth or us through us. Then people like to see their check monthly. So I could burn that cash flow and have lower expenses, but we have our fees to the portal behind our portal that you come into. We have our fees to the accounting guys. It creates more work, but there's something about seeing your money come out monthly that makes it real, makes it tangible, and also, if you understand finance, your IRR is higher, right? Because you have less time exposure that we're holding your money. So it gives you a higher effective yield.
It's brilliant. So let me just show you very quickly, how this would work on our platform. The individual investors sitting there with their bank account, they create wallets on our platform, then pretty much go on the marketplace. A deal like this Phoenix deal comes on the platform. We then would aggregate all the investors. So in this case, there's an opportunity for $500,000. We aggregate all the investors together. We put it through a tax-efficient vehicle, and we basically own the investment alongside DWG and the other investors. Every month, when it pays that distribution, it comes back into a deal wallet and then gets funded into each individual investor's wallet. And just to give you an example of that, if I was to literally go online and let's look at it, and I've got an exciting the minimum investment is normally $5,000, but for those tonight that are here at the launch, you can literally go and read all about it. You can see all the details. You can understand the risk. You can go use the investment calculator. You can download it. You can read everything. But let's just say for now, I like this deal. I like Judd. I want to invest alongside Judd. You can literally participate tonight on the launch. And, our whole philosophy is to allow everyone to invest like the top 1%. You can literally go in, and from $10, you can make the investment. And if you look here, in under 30 seconds, you've just watched me invest in an industrial building in Phoenix. So if you go to my portfolio, there's my pending investment. Again, diversification. I've got one in, one in Germany, and also if I make a mistake, so you can see, oh, hang on, I've done this twice. I can literally cancel investment, remove my investment. I'm in complete control of my money. So I'm not here tonight to give a presentation on how the platform works. but I just wanted to show you that I think the world's completely changed. 10 years ago, me and the investors would fly over, would come meet you, Judd, would set up LLCs and bank accounts and, all of that. And it would take, months, quite frankly, to participate. And now, people have the opportunity to invest directly alongside. And the other thing that I wanted to share with people, if I go back to this presentation, is that this is also not the first deal we've done with Judd. In fact, we're on to our third deal. I think we've done 3 full cycle deals where, that we own the deal, the distributions are being paid on a monthly basis. So, it gives me a lot of confidence in terms of investor that I know when I invest, I've got a good partner on the ground, they've done the due diligence, and I'm going to get my return. So in terms of next steps, it's pretty simple. You literally go to wildmigrate.com, and I've just shown you that you can participate in the deal. And I wanted to finish with this conclusion that, in my opinion, it's an excellent opportunity for investors looking for attractive returns in a stable market. And I wanted to ask you a question, Judd, because there was a question here from someone about the water in, so let me just look for the question. Sharon said, so Sharon is an American, but based in Europe. And she said, question for Judd, how does the access to water or lack thereof impact investment in Phoenix?
This is urban infill, multiple cities under a major MSA, highly established, and it was a former brewery. So, a distribution center. So beer takes water. That was back in the day. For us, like owning an old Coors plant, it's kind of cool if you're an American, right? Especially in the West. No issues at all. No issues at all. We really stray away from anything that's got water issues. To be honest, I've never had a water issue access element in anything I've ever done, except for water rights being an additional value to properties. Perhaps there was cash flows, but we don't zero issues.
Awesome. So, Judd, listen, I really appreciate your time. With a deal launch, I purposely want to keep it short and concise so that people can understand the opportunity. They can go read all about it. They've met you, the partner. We've done webinars. I mean, we did an incredible webinar with you just last week that if people want access to the webinar, they can click on the link below where you actually talked about the American market and why the industrial market. And as you said, you were literally on the ground buying your next building.
It was fun.
Pretty cool. It was like a CNN reporter, like live from a day of closing. But
that was not an easy closing, by the way, so I was happy to share it with you guys. So thank you.
No, well, it's well done on getting it done. But I just want to thank you for your time, for everyone that's participated. Great, reach out to the team if we've got any questions. This is a very limited time offer. And again, I'm not in the game of rushing people, but one of Judd's team members, Ryan, got hold of me and said, hey, look, we gave you this position, but there are other investors that are keen to take it out. And honestly, if you put yourself in Judd's shoes, he doesn't actually care. It's kind of first come, first serve. So yeah. I just wanted to let
I will say, I'd rather do it with you guys. I'd like to keep, I'll give a real color to that. So it really is legitimate. There's somebody trapped in a 1031 that wants to come into the final position. We started this process with you. I'm more than happy to hold it open for you and give you guys a primacy. But it would be very helpful if investors who are going to invest jumped in more quickly.
Yeah, I just think, I'm like, again, our 3 core values are trust, transparency, and alignment. And I'm just being frank that this ain't going to sit around for a while. There will be other deals that will come, but this is a unique opportunity. Again, I repeat, that was bought a year ago. So you've got fixed debt from a year ago. You've got that equity that was already included. You've got a performing asset. So it's, I've done this for 28 years, and this is quite unique. If people do want to participate. To everyone, thank you very much. Judd, to you being online, I deeply appreciate it. We so much value your partnership. And again, just every time you talk, I hope people resonate and understand with how much experience they've got. And they can either go try and learn it all themselves, or they can leverage and partner and invest alongside you. And that collaboration is what I'm so excited about.
It's an honor and a pleasure, gentlemen. Thank you so much. And ladies.
There's a vote. Bye then.